With our closing bell exchange for the day, with us we've got Kourtney Gibson, president of Loop Capital, Oliver Pursche, chief market strategist at Bruderman Brothers, and Holly Liss, managing director at BTIG. Welcome, all of you. Oliver, as we just outlined, a number of very strong reports and very positive reactions. Does this shift sentiment for the overall market?
Well, it's to be seen, right? It's been the Fed against earnings, right? You've got a 3.5% growing economy. You've got 20% year-over-year earnings growth, with strong growth expected still in double digits next year. So that doesn't reconcile with effectively a flat market year to date. So right now, it's as you guys talked about before, is the Fed going to hike too much? And it's not just hiking rates; it's deleveraging its balance sheet.
Why did that all of a sudden become a problem? The Fed's been hiking since 2015.
Well, because you're starting to see some numbers come in on the economic data that are not quite as favorable. It's been very, very robust until about June, July. You know, you had some of the softest spending in bar and restaurants in August that you've seen in 2 years. You've seen a decline in house prices. Affordability continues to be an issue. So all these things are coming together. And at the end of the day, it's always come down to the same thing in markets. There's a small trigger that kind of puts it all together, and that's what we're seeing right now.
Kourtney, have you been using the recent pullback as a buying opportunity?
Most definitely I have personally been using it as a buying opportunity, and interestingly enough, several of our institutional clients at Loop Capital have been doing the same as well. I mean, on our desk today, I think we were better to buy 3-to-1 in Europe and 2-to-1 in the U.S., which is absolutely an attestation, I think, to the fact that we were oversold yesterday. I'm not quite in agreement as far as the Fed, it being kind of earnings versus the Fed. I think it's more earnings versus kind of trade rhetoric and other things that are driving this market into somewhat of a fear-mongering situation versus kind of actually fundamentals driving this market. And I think the Fed has been very, very clear and very consistent. If the data says one thing, this is how they're going to react. If it says another thing, this is how they're going to react. They've been very transparent heretofore, and I wouldn't expect that to be any different as we move into the rate hike potentially in December, or how they view 2019 going forward.
Yeah, that's sort of what Steve Leisman was telling us. Holly, what signal are
Steve's
you getting out
man.
of the bond market? He is. That's why we keep him around. Holly, what are you getting out of the bond market? And specifically, if you could address some of the auctions for us, which have been a little bit of a source of worry.
They have been, because you've really been increasing the size of the auctions. The government has more debt to sell. They need to finance more of the government, and so you're seeing more of these auctions increase in size, and the larger supply makes people back off on what they're willing to pay for it. So we're seeing higher yields come into the auctions. We're seeing less of the bidders taking it at the high price. So as a result, it is giving some concern to these markets, and that is likely adding to the sell-off that we've seen in treasuries, not these past weeks or so, but over the past year, over the past few years, the market has been moving lower in price, higher in yields. And I don't see that really stopping at this point. We're at about 315 in terms of the 10-year. I could easily make the case that we go to 380 in the 10-year. That would take you below about 114 in futures terms. But with the Fed continuing on this hike path, with these interest rates backing up as a result of the increased auctions, there's nothing really to prevent the Fed from stopping hiking or from interest rates moving higher still, and possibly even the curve still flattening.